Rick, thank you for joining us from Canada today. We appreciate you joining us towards the end of your workday over there.
Always a pleasure, thank you.
Now, Rick, look, we've got a lot of clients in Australia and a lot of viewers who are watching this broadcast who are very interested in getting your thoughts on the markets. But before we get into that, could you perhaps just tell us a little bit about how you got your start in the precious metal and I guess resource industry and how long you've been involved in the sector?
Well, I'm embarrassed to say I've been involved in the sector my whole adult life. Sort of a boring guy. I started off doing one thing in my teens and never stopped. I became securities licensed in 1975, I think, and I've been involved in the natural resource business ever since. My very initial response was in oil and gas, but I knew enough soft rock geology that I could sort of get the hard rock part by osmosis. And that great commodities boom of the 1970s gave me a thrill that has just never left. So this is now my fourth cycle. And I've been with the precious metals business for about 40 years now.
Great. So obviously in that time, as you say, you've seen a lot of ups and downs. I guess a lot of precious metal bulls have been shocked, frankly, by the severity of the pullback we've seen in Q2 this year. In hindsight, Rick, should we have seen it coming?
I think so. Cyclical declines are a natural and normal part of a secular bull market. If we go back to the market that caused me to get in the business in the 1970s, it was certainly a spectacular bull market in gold. The gold price advanced from $35 US an ounce to $850 an ounce, an epic bull market. Yet in the middle of that secular bull market, there was a retrenchment in 1975, 1976 that saw the gold price fall by almost 50%, and the mining shares, the gold mining shares, fall by almost 70%. So you had a 12-month, 50% cyclical decline in a secular bull market. People who were shaken out of that, either because they didn't have the cash or the courage of their convictions, missed a move, a recovery then in gold, from a $100 bottom to an $850 top, an eightfold move over 6 years. So I think that people who understand that past is prologue will understand that cyclical declines are a natural and normal, if unnerving, part of a secular bull market.
Yeah, my sentiments exactly, Rick. Now, obviously there's been a lot of news and a lot of noise as to why precious metals have sold off as aggressively as they have, a whole handful of reasons proposed. What would you say that the sort of top 2 or 3 reasons are for the sell-off?
That's a great question. I would suspect that the number one reason for the sell-off is that in the near term, prices for gold and silver are set in the futures market. They're not set in the physical market. And the futures market and the ETFs have been governed by momentum players, often carry trade players. So the futures markets were characterized by a leveraged long buyer involved in a hedge trade. What we have seen in the last 2 or 3 months has been a move of gold from weak leveraged long institutional players to physical retail unleveraged players. But as I say, in the near term, the markets are determined in the futures market, and the unwinding of the leveraged long momentum trade in the physical and the leveraged long momentum trade around GLD in the ETF business has been very, very, very difficult on the gold market. I would say that the second reason why gold has done well is because the momentum that came out of gold began to discredit the narrative around gold that existed in the 2009 to 2010 time frame. If you look at the big picture economics around the reason why people would buy gold, there isn't much that's changed since 2009, 2010. I don't think that any of your listeners could name a G20 country with a balanced budget. I don't think that any of your listeners would suggest that the big banks around the world are solvent. I don't think that any of your listeners would suggest that with $17 trillion in on-balance sheet liabilities and $60 trillion in off-balance sheet liabilities, that the U.S. budget is in any danger of being balanced. I don't think that any of your listeners would suggest that the artificial manipulation of interest rates is ultimately sustainable, or that as a consequence of these low interest rates, that the 10-year Treasury is a real viable option. But despite the fact that none of the discussion surrounding the gold market has changed, the perception has changed, and that means that the price has changed. If the only things that have changed are perception and price, what prudent speculators will come to understand that what a bear market actually is a sale. And that's my point of view.
It's a great point of view, Rick. And look, one of the things that was really interesting about your answer there was the difference between, I guess, institutional money, which is quite short-term in its outlook, and retail investors who are literally buying and storing physical as a long-term store of wealth. Ultimately, do you see that as a bullish development then for the next leg of the bull market, that money's moving into those stronger hands?
Yeah, absolutely. In my experience, first of all, bull markets cause bear markets, and bear markets cause bull markets. That's what happens. And you're seeing a situation now, which you see in all bear markets, where the asset class moves from momentum-oriented weak hands to fundamentally oriented strong hands. There's disintermediation in gold out of sclerotic Western central banks into emerging market banks that have less overall debt in their societies. You are seeing gold move from the hedge funds and the carry traders to the physical individual buyers. This is a classic sort of thing that you see across many, many, many asset groupings in a bear market.
Absolutely. And in terms of business for you guys, Rick, how has it affected you, this rather severe correction? Are most of your clients still comfortable with their position in precious metals and resource stocks, or is there a little bit of fear on the street now?
Oh, I would say a little bit of fear understates it substantially. There's a lot of fear. With regards to our own business, it really has to do with the duration of the customer. If the customer has been with us through a couple of decades, then this is the third or fourth cycle that the customers have seen. And those customers are, in fact, adding to their positions. If they were customers that came to us in 2009 or 2010, customers that came to us during a bull market top, I must say that they have less courage and less conviction and, frankly, less cash than the customers that have been with us for a couple of decades, which is also natural and normal in a bull and bear market cycle.
Fair enough. That makes perfect sense. I guess most importantly, or one of the questions that will obviously be on all of our viewers and people watching this broadcast minds, Rick, is, do you actually think we are very close to a bottom in precious metals now, or do you think we might have one last shakeout ahead of us?
I know you're looking to make me feel better, Jordan, but I don't have an answer to that. The timing question is very difficult, but I can tell you this. This is my fourth major cycle, and most people don't get this, either at bull market tops or at bear market bottoms. But bull markets cause bear markets, and bear markets cause bull markets. At some point in time, 3 years from now, 3.5 years from now, we're going to look back at this, and in terms of pricing, this will have been the good old days. I'm not so sanguine about 3 or 4 months from now. I can't tell you what's going to happen for the balance of this year. But I can tell you, because this is my fourth cycle, demand for gold is not going away. Demand for oil is not going away. Demand for platinum is not going away. Demand for uranium is going away. But I suspect that demand for 10-year U.S. Treasuries at their current interest rate, while it won't go away, will be substantially less dramatic 2 or 3 years from now than it is now. In other words, gold, relative to what I would laughingly call anti-gold, U.S. Treasury securities, will reverse, and reverse in very, very, very dramatic fashion at some point in time in the future. The $64 billion question, like when? I have no earthly idea.
Yeah, they used to call it the $64,000 question, but I think that was back when we were still on the gold standard.
That's right.
Rick, one of the questions I want to ask you, which I find particularly interesting, sort of obviously following both the mainstream financial media and I guess what we'd still call the alternate financial media, is the kind of is what we see on Bloomberg and more traditional finance outlets. And there's been a sort of almost constant bearishness and dislike of gold over the last 10 years, really for the duration of the bull market. And those people are certainly having their moment in the sun right now with the price being as weak as it is. What's your take on the sort of, I guess, mainstream financial media and also mainstream asset management's view towards precious metals?
Well, I think describing them as mainstream describes the paradigm very well. It's much more pleasant for most people, for mainstream audiences, to believe that their actions and our collective actions have no consequences. The gold trade is a trade that suggests that the collective is bankrupt, that we have lived as Western societies beyond our means for 20 years, and that the promises that we've made to each other as societies and a government can't be kept. It's much more pleasant for people to believe that the big thinkers of the world, if you will, the Obamas, the Geithners, the Merkels, that these big thinkers can somehow handle our way through the fact that we've made unsustainable promises to each other. It's interesting to watch when something blows up. As an example, the bail-in in Cyprus. People regard that as a market failing. It's a regulatory failing. We've made promises around the world that if you stupidly put your money in bankrupt institutions, that somehow government should get the money back from you. There seems to be a belief that if you become morbidly obese or smoke too much or drink too much, that health care should be your right. There seems to be a belief on a global basis that if you don't save for your retirement, that's okay, that the rest of society should save for you. The point is simply that we have made promises to each other which we can't keep. And the mainstream media exists by selling advertising to hundreds of millions of people who desperately want to believe that everything is going to be okay, that the big thinkers can keep them from their own actions. 160 years ago, Ambrose Bierce, in the Devil's Dictionary, wrote that there are two meanings to the word confidence, and one of them was also the root word to the word con. And people desperately would like to be conned, and that is why I think there is the mainstream media's antipathy to the metal.
Absolutely right, Rick. Look, Rick, one question I want to ask you, there's been a lot of talk of, with the Fed potentially unwinding QE, that we might end up seeing if not a low inflation environment, potentially even outright deflation, and then there's fear that the gold price would get crushed in an environment of deflation. What's your take on that?
Well, my own take with regards to quantitative easing is very different than other people's. I don't believe that it is any longer primarily a method to introduce liquidity into the system, which is what it's described as. I think it's a function of the fact that the U.S. government can't pay its bills without borrowing, and it can't sell all the debt it needs to issue on the market. So it needs to buy it from itself, which is a long way of saying that they need to counterfeit. If counterfeiting was such a good idea, they ought to let you and I do it for them. I mean, I don't know about you, but I'd be happy to print up $1 billion worth of bills myself and circulate them. My own suspicion is that the ability that they can substantially taper down quantitative easing is only going to be a function of a truly recovering economy. And I don't see the economy reviving fast enough that tax receipts can outpace expenditures in any reasonable time to allow a tapering off of QE.
Yeah, I agree. I mean, I think for all this talk of austerity and winding back the budget, there's actually no surpluses in sight as far as the eye can see. So it may be a case of acting slightly less irresponsibly, which is very different from behaving or living within your means. Rick, I saw an interview maybe a month ago that you did where you talked about how you would invest $100,000 in precious metals today. I thought it was a really interesting and an excellent sort of bit of information you shared. Would you care to just repeat that and potentially update that for our viewers today?
Sure. I don't remember that interview specifically, so I'll have to wing it. But I think the first thing I have to say is that punters on both sides of the Pacific need to recognize that if they think that the metals are going to increase in value, buy the metals, not the stocks. Buy the stocks if you think that there is something intrinsic about that company that's going to cause it to increase in value. The operational risk or the exploration risk or the financial risk that you take in a company is high enough that you need to get the metals price increase built into the share price for free. So if you think the gold price is going to go up, buy gold, not gold stocks. Buy the gold stocks when you think something intrinsic in the company is going to do well. And secondly, of the three precious metals, that is gold, silver, and the platinum group metals, well, I think that the gold price is going to go up for reasons that we've discussed. And I think that the silver price is going to go up because it's the, if you will, poor man's gold. I think the platinum and palladium prices are the surest to rise. I think that the platinum and palladium business does not earn its cost of capital and has not earned its cost of capital for 6 or 7 years. I think either the price of platinum and palladium will go up, or there will not be adequate supplies of platinum and palladium to put in the catalytic converters that give us the air quality that we enjoy on both sides of the Pacific.
Righto, that's great. Actually, that leads to an interesting question that one of our viewers sent in, Rick. He basically stated that, you know, with the rout that we've seen in junior mining companies over the last, I guess, 18 months, now really is the time where bold investors who are willing to sort of catch that falling knife could make, really life-changing returns over the next few years. Are there any Australian companies or things out there that you think are of interest and might fit that criteria?
Yes, they are, but I'm precluded by U.S. securities laws from naming names until and unless I know the investor well enough to determine his or her individual needs and aspirations. In other words, the U.S. government strives mightily to protect investors from themselves, and generally they succeed.
Fair enough, fair enough. Rick, on to Australia just briefly. We've got a few minutes left before we need to wrap things up. But obviously, now down under here, we've gone a couple of decades without a recession. We really have been the lucky country so far. We've ridden, this incredible boom in China, and we've also had an incredible housing boom over the last 25 years that didn't suffer during the GFC like most of the developed world. Can I just get, I guess, your personal view on the outlook for the Australian economy and also the Australian dollar in the foreseeable future?
I think what's coming up will feel unpleasant to Australia simply because, as you say, it's been 20 years since you had your own reckoning. You had a unique set of circumstances. You had a period of very, very, very bad budget problems in the early 90s, which caused Australian society, at least in terms of their external debt, to be very prudent. Similar to Canada, in a sense. You got your house in order long before it was fashionable. Having got your house in order, you were in perfect position to enjoy a tremendous run-up in the iron price and the coal price, and a nice enough run-up in energy prices generally that the Northwest Shelf, which might not otherwise have been developed, got developed. So you had a wonderfully fortuitous set of circumstances. What I think happens in Australia now is that for the next 5 years, things are merely good. And that's going to feel very bad because Australians are used to perfect. From a global perspective, what you're going to go through would seem pleasant. From an Australian perspective, it might seem like a shock. I know I've had a house in New Zealand for some number of years, and the depopulation of my little village in New Zealand as people decamped for Australia has been astonishing, a testimony to the strength of the Australian economy. And as I say, it isn't something that Australians are going to enjoy for the next 5 years because I think some form of reality is going to set in. But I still think you're uniquely positioned compared to the rest of the world.
Yeah, I would echo those sentiments. Rick, before we finish up, a couple of last things. I guess one of the main issues or the key questions out there for precious metal investors is what is the likely catalyst for a turnaround in the gold price? I mean, things like QE, low interest rates, economic uncertainty, we know these factors are going to be with us for some years to come, which kind of tends to think or make one believe that there's going to need to be something from left field to actually spark this catalyst. Any ideas as to or feelings as to what that might be?
Absolutely. I don't think there's one catalyst. I think it's several catalysts. One is that, and this may sound very ethnocentric, very American of me, but the risk-off trade on a global basis would right now seem to be to U.S. Treasury securities. At these artificially low interest rates, a famous American newsletter writer, Jim Grant, has characterized the U.S. Treasury as return-free risk. At some point in time, global investors have to ask themselves how attractive the prospect of return-free risk is. And I suggest when they answer that question, two things will happen. Gold will gain some competitive traction simply as an alternative asset class, and the lead dog in the race, if you will, the U.S. Treasury, will look somewhat less attractive. The second thing is that I think that the increasing amounts of gold that are being bought in the physicals market eventually will begin to turn the futures market. When the momentum players in the futures market are unwound of their position, in other words, when the need to sell in the futures market is exhausted, and hence that selling is exhausted, the extraordinary strength that we see in the physicals market will carry the futures market higher, unwinding the trade that we've seen in the last 4 or 5 months. The third thing is that for buyers on a global basis, and it's related to the second thing, for buyers on a global basis, $1,250 US dollar gold is substantially more attractive than $1,900 US gold, particularly when the US dollar has also been strong against other currencies. If you unwind those two factors, the gold price is simply more attractive at $1,250 than it was at $1,900. And you'll get a normal reaction with bargain hunting, rational buyers coming into the market.
Couldn't agree more. Look, Rick, I know you've probably had a very busy day and got other things to get on with, so I'd like to thank you very much for your time. I'm sure all of our viewers and people watching this have really appreciated your insights. Now, you are coming down to Sydney in October. You're going to be speaking at the Gold Symposium. Really look forward to meeting up with you and catching up there. And for everybody watching this, it'd be a great idea to come along and watch Rick speak at that event.
I'm certainly looking forward to seeing you and as many of your viewers as I have the ability to see in Sydney. I quite look forward to that summit. And while I will not be able to tell people the names of Australian stocks that they should own, I will be telling them the names of stocks that I own, because that's a disclosure of a conflict of interest rather than a recommendation.
Sounds like a good way to get the message out there.
Thank you.
Cheers, Rick. Thank you.
Bye-bye.